Most people focus on the moment popularity peaks, the record-breaking auction, the viral TikTok trend, the overnight sellout, the influencer endorsement, the headline, "This collectible just exploded in value." But the real story doesn't start there. It starts the day after. Today, we're looking at what really happens after popularity peaks, when attention fades, speculation cools, and long-term consequences quietly begin. Because in collectibles, the moment of maximum excitement is often the beginning of maximum risk. This is the day after popularity peaks. Let's start with the moment everyone remembers, the peak. It looks electric. Prices climbing daily, auction results shattering estimates, social media flooded with "you need this now," new collectors rushing in, dealers raising prices weekly. It feels justified. It's rare, it's iconic, it's culturally relevant. It's different this time. At the time, this decision made sense. Buying felt smart, holding felt obvious, paying a premium felt necessary. The assumptions? Demand will keep growing. Scarcity guarantees value. Cultural relevance equals long-term collectability. If everyone wants it, it must be good. And most importantly, if I don't buy now, I'll regret it forever. That's the emotional fuel of a peak. The day after, things still look fine. Prices are still high. Market chatter is still optimistic. Influencers are still confident. Collectors are posting their new acquisitions proudly. There's calm reassurance. See? It's holding. Still strong. Just consolidating. Healthy correction. Early auction results still come in strong. Short-term calm creates long-term confidence. And here's the important tone. No judgment. Because in the short term, the market often does look stable. There's liquidity, there's activity, there's belief. It feels validated. And that validation delays caution. This is where the invisible shifts begin. Not dramatic crashes, not panic, subtle changes, fewer new buyers entering, more listings appearing, longer time to sell, private discounts increasing quietly. Behavior shifts. Collectors who said "I'll never sell" start testing the market. Dealers widen spreads, buyers negotiate harder, forums get quieter. Pressure builds in invisible places. Over-leveraged buyers, speculative flippers, investors who entered late, collectors who bought emotionally at peak. Small compromises begin. I'll accept slightly less. I just want to break even. I need liquidity. These are early trade-offs most people don't notice. But this is the core shift. When demand slows, supply suddenly feels bigger. Nothing dramatic happens, but momentum quietly disappears. The consequences don't arrive loudly, they arrive slowly. A 10% drop becomes 20%. Auction houses lower estimates, buy it now listings sit unsold. The narrative changes from explosive to cooling. And then one day, someone says, "What happened?" It feels sudden, but it wasn't. Nothing broke overnight. Popularity peaked. Speculation stretched valuations. Supply expanded. Emotions normalized. Markets don't collapse because they were bad. They correct because expectations were unrealistic. The peak was emotional. The aftermath is mathematical. Most people don't ignore problems. They simply don't see them yet. Here's why. Cognitive bias. We anchor to peak prices. Anything below feels temporary. 2. Overconfidence. I did my research. I know this market. 3. Process blindness. We watch price but ignore liquidity, transaction speed, and buyer depth. 4. Emotional investment. It's not just money, it's identity, community, belonging. 5. Market inertia. Platforms, influencers, and sellers benefit from continued optimism. The system doesn't scream "slow down," it whispers. And whispers are easy to ignore. Experienced collectors don't judge decisions by the peak moment. They judge them by the day after. They ask, is demand organic or speculative? Who are the buyers, collectors or flippers? Is supply truly scarce or temporarily tight? How fast are items reselling? What happens when hype fades? They monitor signals, time to sale, discount frequency, grading population reports, reprint announcements, cultural longevity. They expect behavior to change after a peak. They plan for slower markets. They buy quality, not momentum. Because real value survives quiet periods. Hype does not. The lesson isn't don't act. The lesson is plan for the day after. One mindset shift. Instead of asking, will this go up? Ask, what happens when excitement fades? One framing principle. Peaks are emotional events. Value is a long-term story. One long-term question. Would I still want this if nobody else was talking about it? If the answer is yes, you're collecting. If the answer is no, you're speculating. And there's a difference. Most collectibles don't fail at the moment they peak. They fail in the days, weeks, and months that follow. After the headlines, after the Instagram posts, after the record-breaking auction. That's where the real test begins. If this changed how you think about hype cycles and collectibles, that's the goal. This is the day after. And next week, we'll explore the day after a reprint is announced. Because in collectibles, the story is never about the peak. It's about what survives after it. If you value thoughtful collecting over impulsive buying, subscribe to Collectiblepedia. We don't chase hype, we study it.